The rupee hit a fresh historical low today with the dollar index touching a fresh 20-year high of 108.2. But let's emphasize on the point that the rupee has fared better than other emerging market currencies. The Indian currency has tumbled 6.6% this year against the dollar, while Taiwanese dollar has slipped nearly 8%. So now, to boost the rupee, the RBI has been announcing a bunch of measures. Last week, it allowed banks to pay higher interest rates on foreign currency. That was a move that came in last week, and that was on foreign currency deposits. Also yesterday, the RBI announced steps to internationalise the rupee. Let's head across to Anand Adhikari to explain to us how this new measure by the RBI is likely to impact the currency.
I really don't see any immediate impact of these measures. Now let's look at each of these measures. The RBI has freed up the interest rate cap on foreign currency deposit. They have also exempted the CRR and the SLR requirement on such deposit. But banks are already flush with funds. With credit growth in the economy is still in single digit. The RBI has also allowed more choices to foreign investors, to invest in GSEC and the corporate debt market. Here again, when the interest rates are rising globally, these foreign investors have better opportunity to invest in their home market without any currency risk. RBI has also, in a way, doubled the ECB limit for corporate, from $750 million to almost 1.5 billion. Now, corporates in India are also deleveraged. I mean, they are sitting on cash. We are yet to see, private capex happening in the economy. So the expansion in the capacity is not happening. So why will they borrow money now? RBI just did a move. Allowing settlement of international trade in rupee is a good move, but this will take time. The immediate worry, is the foreign investors pulling out money, from the Indian market. The global interest rates are rising. The import bill is rising because of higher global, commodity prices. The current account deficit, it is expected to almost double, to $100 billion in 2022-23. So I see a lot of pressure building up on rupee in the coming weeks.
So how will these steps work? Will countries accept rupees in exchange for their imports? Joining us now, Mahendra Jajoo, CIO Fixed Income, Mirae Asset Investment Managers. Mahendra, thanks for joining us. Take us through the implications of this new measure announced by the RBI.
So this is a good progressive step. At this point, although the acceptance of the rupee as the settlement currency for the exports or imports will be not very high, but then the start has to be made somewhere. And given the current situation, specifically where there is a huge oil import and other commodities import, specifically when there is a government-to-government dealing, this mechanism may help. So that may get an early boost with the government-to-government rates, and over a period of time, the general importers and exporters may also come on board this system.
Sure. So take us through the implementation, the consequence of this move, how it's likely to be implemented, and the kind of detailed impact it's going to have.
No, I think implementation is pretty straightforward. There isn't too much of a challenge. As long as there is an interest from the counterparties from the other countries to settle in rupee, then the implementation is not much of a challenge. The most important part of this whole chain of the transaction is for a foreign bank to open a special rupee vostro account. Like right now, when the Indian establishments are importing or exporting, they open a nostro account with a foreign correspondent bank. So in the reverse settlement mechanism, a foreign bank, the bank of the country of the origin of export, for example, will have to open a vostro account with the Indian bank.
Okay.
So as long as they are willing to settle the trade in rupee, I think in terms of the implementation, there is no major logistical challenge. Sure. That should be straightforward.
All right. So what about the monetary policy, Mahendra? Because it could potentially make it a little tougher on monetary policy. What do you think?
Not really from a monetary policy perspective, because ultimately, even if the trade is settled in the rupee, let's say we are importing a machinery from abroad,
sure,
then the payment will still have to be made in dollars. The only implication of the reversal of the mechanism is that earlier the local person who is importing will have to find dollars and then pay to the exporter of the other country. Now he will settle in the rupee, and the other person will have to sell the rupees in the global market and buy dollars, because he's not going to keep the rupees for his purpose. So the demand pattern will somewhat reverse. It will obviously be help in terms of the rupee stability. But then from a monetary policy perspective, it is not materially different from importing in dollars or importing in rupees. Just the currency risk shifts from the importer to the exporter of the other country, and to that extent there is going to be somewhat less pressure. But then again, he is going to have to buy dollars by selling rupees. So I don't think it establishes rupee as the brand rather than having any serious or meaningful implication for the monetary policy. That's how I understand it.
All right. Thank you for joining us, Mahendra, with a detailed look at what's on the cards for the currency.
If you like the video, do like, comment, share and subscribe.